Sellers are cutting the price once again in the US housing market, with home prices likely to go down for the rest of 2023. With new data from Realtor.com showing that in July, median list prices in America's housing market went down by 1.1% on the month. Similar decline to what we saw last year before the bottom fell out on the housing market. And the reason prices are heading back down is because buyer demand has absolutely collapsed over the last couple months. With Redfin now reporting that their home buyer demand index is down 5% year over year at its lowest level going back to 2020. Moreover, mortgage applications to buy a house just plummeted to their lowest levels since 1995. And thus, no wonder we're seeing sellers in the US housing market begin to cut the price, especially in certain cities across America, everyone. I'm going to talk about the top 10 cities where sellers are cutting the price later in this video, but just to give you a little preview, you can see it's the areas in red on this map. This is where the sellers are getting most antsy and desperate to cut the price. You can see it's a lot of places in Texas, it's some places here in Arizona, Utah, as well as a market like Nashville in the Southeast, where we're seeing more and more listings on Zillow with pretty hefty price drops and motivated sellers. And ultimately, everyone, I think a lot of people got tricked and fooled in the housing market over the last couple months, because in the spring and early summer, there was lots of news reports about a recovery occurring in the housing market. And in fact, we did see prices go up in the spring. The same data from Realtor.com did show monthly price increases in March, April, and May. However, what people forgot is that home prices go up every spring. The housing market is very seasonal, and sellers are always optimistic in the spring and increase their list prices and then end up dropping them in the fall and winter. And this seasonal trend is something that even occurred back in 2007 and 2008 during the beginning stages of the biggest housing crash of all time. Now, of course, the prices are going down again, the buyer demand is in the tank, and we're seeing a big headwind come from mortgage rates and interest rates, because as you guys know, these mortgage rates have been increasing over the last year and a half. They went from 3% to 7%, but in fact, they've increased by even more over the last couple weeks, because we have a big issue right now, and that's the fact that the US government just got downgraded on their ability to pay the debt. Fitch downgraded the US government from AAA to AA+, and that downgrade has now caused treasury yields, the amount that the government has to pay to borrow on the debt, to go up, with the 10-year treasury increasing from about 3.8% in the middle of July all the way up to about 4.15% today. And that increase in treasury yields and how much the government has to pay to borrow is now causing mortgage rates to go up by more, with the 30-year fixed mortgage rate hitting 7.15% today, which is frustrating news for home buyers. You're not going to get any immediate relief from mortgage and interest rates, and I think the reason is because all that borrowing that the US government has done over the last 10 to 15 years, and a couple years especially, is now catching up with it. For instance, the total public debt in America held by the government is now all the way up to $31.5 trillion. That's more than triple the level it was in 2008, which is, I think, now causing some creditors to America to get a little hesitant in terms of lending America money, and thus these creditors are demanding higher yields and returns, which is likely to keep mortgage rates structurally higher until the Federal Reserve inevitably pivots on their policy and slashes interest rates. But of course, a big factor in that is going to be inflation. How under control is inflation right now? I'm curious what you guys think in the comments section below. Have we vanquished the inflation problem? Annual inflation rate is now down to 3.3% year over year with the most recent data from the Bureau of Labor Statistics in July. That's close to the 40-year average on a year over year basis. So the inflation's looking better. However, there's still a lot of uncertainty and skepticism about where inflation is going to go in the future. There's some people who think it's going to go back up over the next 6 months as we see energy and oil prices go up, as we see potentially another run up in food prices. However, there's other people like myself who believe inflation is going to continue to go down over the next year. And one of the reasons I think that is looking at the rental market, with rents in America now officially going down, with new data from Apartment List showing that rent growth is now at 0.7% year over year. So rent is still high, but it is now officially on the decline according to Apartment List, with 67 of the 100 largest US cities experiencing negative rent growth year over year, with Boise, Idaho being the hardest hit at -7%. Now, these declining rents are an interesting phenomenon because real estate investors specifically were not anticipating declining rents. A lot of investors bought into the housing market and bought rental properties over the last 2 years on the idea that rent would continue to go up in perpetuity. But now that rent is going down, it's throwing some of these investors for a really big loop. Like on this rental property in Nashville, it's on the market for rent for $2,400 a month. However, you can see it was originally listed in late May for $2,550 and hasn't been rented yet. So it's been sitting vacant for 2.5 months. They're cutting the rent after buying this property for $509,000 earlier this year. And I think some of these investors are starting to feel a little distress and a little squeeze, because when you do the math on how much they purchased the property for how much their income is going to be from the property, it just doesn't make any sense. And I think there's going to be a liquidation coming. Let's just do the math on this investment property so you can understand what these investors are doing. If they get their current monthly rent of $2,400, that would be $29,000 a year in annual rent. Now that's not bad. However, you have to back out the expenses for vacancy and property taxes and insurance and maintenance and management. And those $10,000 in expenses leave only $19,000 in income. Divided by the purchase price of $509,000 is a 3.8% cap rate, which is really low. That's a really low return. Right now, you can invest in a short-term government bond and earn 5.5%. Assuming this investor bought with an 80% leverage mortgage, so that would be a $400,000 mortgage at a 7% interest rate, they would actually be losing $9,000 a year after paying their bank and their lender. Folks, there's lots of investors out there like the one I just showed you who bought in close to the top, who bought in at a low yield and are now struggling to rent their apartment, and they haven't sold because they somehow think everything's going to turn around for the positive. Folks, it's not, because the rental markets there are crashing with a gigantic surge in the number of just vacant apartments and houses sitting on the market. For instance, data from Apartment List shows that the vacancy rate in Nashville has skyrocketed up to 9.3%. There's more than 2 times as many vacant apartments now as there were a year and a half ago when most of these investors got the idea to buy into the market. Same thing in Austin, Texas. The vacancy rate is up to 9.5%. That's close to the highest level on record according to this data. What about Phoenix? Same thing. The vacancy rate's up to 7.9% in Phoenix, well above the long-term average. And so I'm really struggling to see the upside proposition here for a lot of these landlords and investors who bought the last couple of years, because they have higher vacancy rates, lower rents, their cost of debt has surged. A lot of them bought at a low yield. I mean, that concoction, folks, is going to lead to forced selling and liquidations. And I can't tell you exactly when that's going to happen. If I'm going to be honest, I thought it would have already happened by now, but it will happen at some point, because people can only lose money for so long before they're going to be forced to sell. And where is this potential sell-off from investors going to hit most? Well, it's going to be in the pandemic boomtown housing markets for sure, folks. Because if I pull up data on Reventure app, folks, I want to show you something here. I'm going to show you the cities where prices are likely to go down the most over the next 6 months. And here's how I'm going to do this. Only going to look at cities where inventory has grown. Only going to look at cities where there's a lot of sellers cutting the price. And we're only going to look at cities where the days on the market has increased substantially. And what do you see? What are we left with, everyone? These are the areas, objectively speaking from data, where prices are likely to go down the most. What do you see? It's in Tennessee, it's in Texas, it's in New Orleans, Louisiana, it's in Florida, it's in scattered parts of the mountain regions of America and the Pacific Northwest. But of course, everyone, there's big differences within a city in what's going on in today's housing market. This is a bifurcated housing downturn so far in 2022 and 2023. And what that means is that certain neighborhoods are actually feeling it and feeling it pretty hard, whereas other neighborhoods aren't feeling it that much. For instance, if we take a look at Southeast Florida and look at Miami, Fort Lauderdale, and West Palm Beach, where are we seeing sellers cut the price the most? Well, these areas in blue near Miami have a fairly low share of price cuts, not much selling pressure yet. Whereas if we head up to Boca Raton, Boynton Beach, and certain areas near West Palm, there's a lot more price cuts. But ultimately, folks, we got to deal with the realities of what's happening in the housing market overall right now. And that's that things are still very expensive here in the second half of 2023. The typical payment for a home buyer in America right now is up to north of $2,700 a month when you factor in mortgage interest, taxes, and insurance. That's over $32,000 per year when the median household income in America is only around $75,000 a year. So the typical household right now needs to spend close to 40% of their gross income on their house payment if they were to buy in today's market, and that's simply too high. I mean, that's right there telling you why buyer demand is so low. why mortgage applications are at the lowest level since 1995, why Redfin's homebuyer index is down 5% year over year and 25% over the last 2 years. It's because the affordability is so bad in today's market that when you go on Zillow and look at a listing and you look at the price and you look at the payment, you can't help but feel sick to your stomach sometimes as a home buyer and wonder, how is this even possible? How are some of the sellers in this market, despite the fact that they've started to cut the price, how are they still thinking they can charge so much? And the answer to that question, everyone, is that sellers are stubborn. It is so important that you understand this, that even if someone's owned a house for 20 years and has seen the value go up by like 300%, they've baked into their mind now what they think they can get when they sell it. And to them, if they don't get that price, even by $20 or $30 or $40,000, they think they're losing money, even though they're still making a 250% return. I mean, just folks, take a look at this listing in Nashville. They just did a $19,000 price cut. They originally bought this 3-bed, 3-bath house back in 2003 for 63 grand, and then they listed it in July for $500,000, 700% appreciation. And of course, that price was too high. Now they've started to cut it. And you see to yourself, why wouldn't this seller, knowing that we're in a housing downturn of some sort, why wouldn't they come to market at a more reasonable price? Like, why wouldn't they come in at or below the Zillow value estimate of 455? Oh, like I said, folks, it's because they're stubborn. They have this idea that it's worth this. Their realtor said, oh, I can get you that price. And they're not going to want to let go of that right away, which is why housing downturns are slow moving beasts, everyone. They don't happen in 6 months. They don't happen in a year. They happen over 5 years because it takes time for sellers to get out of their own way and to reduce the price to a level that home buyers can afford. And that's ultimately what's going to need to happen before we see a return of home buyer demand to the housing market. We're going to need to see a reset on both prices and mortgage rates to a lower level where, simply put, home buyers don't need to spend 40% of their gross income to afford a house. And one metric that I'm looking at to kind of dictate to me if we're entering a situation where buyers are feeling better about the housing market is a survey done by Fannie Mae, which tracks home buyer sentiment in the U.S. housing market. And they ask home buyers questions like, do you think it's a good time to buy a house or a bad time to buy a house? According to the most recent version of this survey released earlier in August, right now, 82% of Americans say it's a bad time to buy a home versus 18% that say it's a good time to buy a home, which is some of the most negative sentiment ever for the U.S. housing market. You can see, normally speaking, like before the pandemic, more people thought it was a good time to buy than a bad time to buy. And so one thing I'll be watching out for is if this sentiment changes in future months. Like if all of a sudden the percentage of people who think it's a bad time to buy starts plummeting and the percentage of people who think it's a good time to buy starts going up, well then, it's probably a signal that we'll see a rebound in home buyer demand, mortgage applications, and home sales. But that's not going to happen until both prices and mortgage rates go down and go down by more. And potentially we could see relief on mortgage rates. Like the Fed, I think, will pivot at some point. The fact that rent is now going down in America is a signal that inflation, which we talked about before, is also likely to continue to go down. Right now, this inflation is at 3.3% a year. Maybe it's going to go up more into the future a little bit due to energy prices and what's called the base effect shifting. Maybe it goes up to 4.5% in a couple months. However, the fact that rents are now going down, the fact that asking rents are declining, is a sign that what's called CPI, rent of a primary residence, which is still at 8.3% year over year, the rental figure included in inflation, that's going to go down because the rent calculated in inflation is a lagging indicator, which follows the change in asking rent, with rent being 32% of the inflation calculation. So if rent continues to drop, we know that inflation is going to drop. And if inflation continues to drop or stabilize at a more acceptable level, the Fed might pivot. I mean, right now, the betting markets are saying that by the end of the year, the end of 2023, we're likely to see interest rates exactly where they are today at 5.25 to 5.5%. Maybe they're one interest rate hike higher by the end of 2023. However, by the end of 2024, the betting markets are saying interest rates are going to be actually 4 to 4.25% and could even be lower than that. So the betting markets are saying Fed's not going to pivot in 2023 and cut rates, but in 2024, they probably will. Now, that's a long way away. An interesting question to ask is, what's that going to do to the housing market and economy when the Fed starts cutting rates let's just say a year from now or 9 to 10 months from now? Well, that really depends on how advanced the economic downturn is. I suspect the economic downturn is going to continue to get worse with interest rates just so high compared to where they've been. And so I think we could see the Fed cut rates in a year, but I don't necessarily think those rate cuts are going to invigorate the housing market like people think. I think they're going to be associated with a worsening economic downturn in layoffs and job losses, which of course is not going to be good for the housing market. And in particular, are we going to see some of these investors who I showed you earlier in this video that are having issues, are we going to see them forced to sell by the time the Fed pivots? That's going to be a really interesting question and one to watch. Now, finally, everyone, one last thing. If you are an investor in the housing market who wants to position yourself well for this downturn and understand the right cities to buy and areas to buy, well, what should you do? And for me personally, folks, I would target the highest cap rate markets, which is a data point here on Reventure app. You can see here these areas in red in America have higher cap rates, higher returns for investors from day one, so you don't need to be as reliant on future rent growth and appreciation to justify your return. Additionally, folks, Reventure app now has cap rate data for every zip code in America as well, so make sure to check that out if you haven't yet on Reventure app. We have cap rate data for every zip code in America going back to the mid-2000s.